you. Today is Tuesday, 5th of May, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. And yesterday I was talking about scaling a business, right? So when you go from this commercial growth with efficiencies that are based on your performances, your brand, your people, and your capacities to scale with the same cost or closer to the cost that you currently have. We gave the example of a house. So if you have a house that you want to value the equity of your house, and if you do improvements, that actually you have the pretty much the same property, but actually the valuation increases, and you can prove that. So today is a different question. Can the business grow without becoming too dependent on the founder? And you say, well, this is a recurring theme. Why is that happening? Because it's happening all the time, every single day. And last night we had a meeting after 2 in the morning with a very, very skilled team of advisors studying a particular deal. I'm probably going to mention a few things here that actually were quite interesting when we were studying this opportunity. So let's look into the designed our operating system. So here's a full operating system. So where all this happening at the same time when you are running a company, when you are valuing a company, when you are exiting, or when you have a company and say, how much is really worth my company? Because I want to understand what value I created or how is appraising the value of this company in time as we put all this time and effort to make it better and bigger, right? So today's section is all about on the far right, which is predictability, right? Because part of having a very good company also is a quality or the qualities that make it predictable, right? So that you are going to grow and you're looking for capital, and this is part of the things that you have to prepare even before thinking about raising capital or talk to your shareholders or go to the bank or institutions or investors. From the assets point of view, we're going to talk about partnerships, revenues, and your assets. And from the valuation point of view, today is about trust. So how trustable is your organization? And trust is very subjective because actually people trust or not trust, they have that feeling, that gut feeling about you or your company or the market, right? But when you have these elements put together in paper, it's very much easier to start to trust your story, your narrative, your history of how you arrived to this point and how predictable is the future. Now, it's true, nobody knows the future, but actually certain patterns of behavior also, even with ups and downs, can start to draw a line where the things are going, and they are very likely to go that way. And when you have that in front of your investors or your officials in the bank or your shareholders, it's way much easier to explain why you are growing or what is your plan or to support your plan to growth and the raise of capital. So if you remember, yesterday we were talking about a founder that wanted to go to a different geography, but today we are talking about the money, right? So the money asks different questions. The question that will ask, when I say money, is actually shareholders, founders, investors, etc. So what is a question that will ask? And you will come across these questions. Is the revenue repeatable, right? It could be, is a contract in place? Are the assets clean? I mean, actually, do you have your intellectual properties, your machinery, your real estate, etc., in your organization? Is all this clean and correctly set up for securitize your loan or your investment or your structure of the organization that can accept a new shareholder? Are the partnerships useful, right? So if you're distributing through partners, are they useful or they are consuming time and resources, not really creating a better impression of your brand or increasing the customer loyalty or sales, etc.? Are the numbers reliable, right? So And reliability, I mean that actually when you have these contracts that are secured, that have a longer term, that have favorable, and favorable doesn't mean taking advantage of other companies. It's a favorable terms in terms of right to collect, right to delivery guarantees, etc. And more importantly, could a buyer or an investor trust the story without sitting with the founder for 2 hours, right? So if you send your package or your pitch deck or your data room to somebody, could they understand exactly what's going on in your organization and is supported by a very, very well structured documentation that actually can support a story even before talking with somebody? If you achieve these kind of things, then you have a way much bigger um, possibility or chance to be trusted, because actually people see that actually there's a methodology, a system, process behind it, so they start to feel more confident or more comfortable that actually this organization knows what it's doing. So this is a point today. Revenue quality is one of the biggest drivers of valuation, by the way, if you are wondering. So, and this is the point that we're going to address today. So, is the recurring revenue, contracted revenue, so what are the contracts you have in place, diversified revenue, transferability of revenue, and all these things reduce uncertainty and increase the trust that the companies or investors or shareholders are looking for. So, this is also in the flip of the coin what it costs the valuation, right? So if all these things are not very, very clear and explained how it works, so which is a recurring revenue, what is a contractor revenue, which is a diversified revenue in different markets on different verticals, what is transferable, so that also plays against you if you don't have that very well organized and explained. So, as I mentioned, currently we are evaluating an acquisition of a company, and they have 30 years of track record in the market, which is absolutely fantastic. The company has real activity and very impressive big international clients in their books, a solid annual collection, steady revenues, historical sales, and all that sounds very promising. But promising is not the same as predictable, because then we start to look into these kind of things and we start to see a few and several cracks in their organization. So the story was very good, but when you start to see, okay, let's start to find out how you support that story in terms of pitching to the market your organization to for an exit, then we start to find a few problems. And the first one was the revenue can look healthy but still is weak, still weak. And the reason why is because the data room pack may show sales, right? And actually they show very good sales. But the buyers and investors ask about, and we were asking about this, repeatability, margin, customer concentration, payment timing, returns, support costs, and founder involvement. And here's the problem. The founder is still central to each deal. The revenue may be real, but not yet transferable. And here's the biggest problem. 44% of these customers of this particular company are repeat customers, which is absolutely fantastic. But all are founder relationships. So the founder says they are a solid relationship, there's no problem there, but our concerns is different. And listen to this, because actually it's very interesting point of view. The founder, remember that this company has 30 years in the market. So the founder relationships are very good, though he is retiring. So guess what happened on the other side? It is 40% of the revenues are coming from this relationship that he built from the last 30 years. And this is almost half of the revenue of the company. So if he is retiring, guess what happening on the other side? The relationships, the people are signing the purchase orders or accepting their quotes and processing or having their services and products in mind when they are doing projects, they are going to retire too if they are not about to retire. So who is going to keep this relationship, or how we build new relationships, is the founder and the people actually they met for and they know each other for many, many, many years. They are not in the business anymore. So even if the revenue look healthy, they're still weak, and that thing in this position where we are going forward with a new team on the company. So the second problem that you likely to find is that partnerships can create noise instead of confidence. And what I mean with this, actually, you may have a partners that can open markets, but they are not really on your side of the story. They're just there for the revenue. If the partner controls the customers, they hides the margin, they slow the cash, or meaning to the payment terms, weakens the report, owns too much of the relationship, then the company has access but no control, and that affects the valuation, right? Because actually you'll say, yes, we have our distribution systems, and I clearly remember this, particularly with OEM products or white label products. So we had a very, very good distribution teams in terms of distribution of the products, but we never knew who were the end users. We never knew who they were selling to. We never knew who they were acting on our products, or how those new products, white labels, were distributed. We recognized them, but actually we never knew how they reach out to those particular customers. And guess what? We only had a purchase order every quarter and a payment every quarter that actually we had to chase constantly, because they were allegedly having trouble to collect from the large network of products that they were selling. So they have very good delivery on time, all what they ask in terms of the purchase order. That was our commitment. But in terms of their commitment to pay on time, as the agreement was put in place, we had a very, very up and downs in terms of timing. And that was affecting very much our reporting and revenues reporting. And anyway, treasury was a bit of a tricky situation with this particular distributor. And guess what? Was a very good distributor, by the way, but we were completely blind of what was going on. So these kind of things can affect your valuation, because if you are, even if there's a predictability in terms of the orders and the collection, when the revenues start to be shaking because of these kind of situations, then you are not as predictable as you're supposed to be. And then you have ups and downs. And then when year end come and you have a down, not an up, that is a problem, right? Anyway, and the third thing that I want to mention is capital is available, but it's not casual. So we have many how can I put this? Many examples of, for example, SBAs in the US, or in the European Union. There are many facilities or instruments to support companies. But guess what? In the UK, particularly, the Financial Conduct Authority, the new capital market regime does not remove due diligence. So you have to do, so this is by a compliance issue now. So you have to do a very thorough due diligence either way. So from the buyers and from the seller. And you say, well, this is by default, this is normal, that's the way it's supposed to be. But there are new market entries. There are new people exiting. There are actually, they call it the gray tsunami. So it's a large amount of people exiting. And guess what? Probably 80% of these companies, they will never sell, and they will just literally close down because they don't have all this information together and ready to market their company to potential buyers. But it's not a lack of capital, I insist. It's a lack of organization of the information. So in other words, imagine that unpredictable revenue is like the rain in a dam, right? So you have the dam, you have the infrastructure, you have everything there, but actually you are highly dependent on the rain. So if the weather forecast is saying it's going to rain and it doesn't rain, the level is still going down, meaning the valuation of the company, right? And this is you see that information based on your track record and your predictability into how that track record shows the tendencies, if you're going up, down, or it's a steady behavior in terms of revenue collection. So the point is actually you have to ask different questions. So the question is, if the revenue is growing, why would capital still discount it, right? So let's assume that actually revenue is growing. So why you are not going to get a better valuation? And here are a few things that you have to consider. And as a board advisor and as or as an advisor, these are the three things I would like you to consider, please. The first thing is test the revenue quality. So break the number down. So what is repeat revenue? One is one-off revenue. What is contracted revenue? What is founder-led revenue? As I mentioned, in this particular case where the relationship seems to be carrying for many years, and what will happen after the founder exits. So what is a partner-led revenue? We mentioned the OEM and the white level situation. So what is delayed cash? So this is how you start to understand why high margins works, low margin works. If the board or the executive team or you as a founder cannot explain the quality of the revenue, the investment will assume the risk is higher than the management thinks. So test the revenue quality. The second thing is the assets location. Where are your assets? And these are many assets that you have to consider, like real estate, machinery, trucks, intellectual property, data, product designs, customer contracts. All these are license rights. All these are assets. So you need proof. Your distribution rights, your partnerships, all these are the assets of the company. This is what it makes your company valuable. So if these are split across unclear entities or weak documents, the asset story becomes harder to price. Then by default, your valuations start to decrease. And the third thing to consider in this model is a partnership control, right? So ask whether each partner improve 5 things, actually, which is the access that you have, the margins, the customer quality, the reporting, and the compliance. These 5 things are very important when you are considering partnership, because if you have these 5 and you can explain them and you provide evidence, it's not that the partner only improve access, it may help growth, but allowing with a stronger valuation rather than to weakening your position. As I mentioned, you might have the contract, you might have a steady order flow, but your collections start to be very volatile, meaning up and down, up and down. And this is weakening your valuation, it's not making you stronger. So last question to consider. If the revenue, the assets, and the partnership cannot be explained cleanly, why should an investor give the company the benefit of the doubt? Meaning, actually, well, I see that actually you are a bit all over the place, but I believe you. It doesn't happen, because the capital or the investors or the shareholders, or when you are looking into the banks, they look into minimize the risk, right? And when they're looking to minimize the risk, they are going to lend you less, not more. And that's when you see that actually that is translated actually as a lower valuation of your organization, because they cannot have that certainty that you can repay the debt or achieve the financial goals that you are proposing in terms of 2 years, 3 years, 5 years, whatever is the case. So what do you gain working with me? Is 3 things: business outcomes, differentiation, and risk reduction. Very important. So in terms of business outcomes, I help boards or executive teams or founders to turn a capital ambition into a fundability plan, right? We have a very well structured process. That means the company moves from we need money to grow, for example, to we can show investors the revenues, the assets, the partnerships, and risk in a way they can trust. In terms of differentiator, I built an international advisory board around your capital milestone. That may include investor readiness, experts in investor readiness, revenue quality, intellectual property review, taxation structure, legal structure, market entry, financial modeling, and capital route design. So all these things require a group of people that are very qualified and expert in these areas. So how much is going to bring a consulting firm to this? Very expensive. We do it at a fraction of the time with the right experts, with the right time. And guess what? We can rotate the team as you achieve certain milestones. So you always have a pool of experts supporting your organization every single time, every 6 months, every year, etc., etc. And how it helps you to reduce risk? This model, this advisory board operating system, reduces the risk of going to investor too early. or damaging your valuation, or exposing weak documents, or creating avoidable doubts around the founder, like it's too dependent on the founder. So we create a mechanism so the founder start to work on the business rather than still in the business. That gives the company a cleaner route to capital without the overhead of a large consulting firm. So one action you can take today, and you can do it in 30 minutes or less. Before your next meeting with your team, ask for a one-pager fundability scorecard with 3 columns only: partnerships, revenues, and assets, right? And then you have the red, yellow, and green. And each one should have a sentence or evidence that score your readiness. Yes, for example, if you have the partnerships, that actually you have a contract, you have the steady order flow, but your collection is very unstable, then that might be a red or a yellow because you had to fix something there. But if you have a partner that actually the revenue is very steady, the order flow is steady, and then you can see how it's helping you to grow in the market, that will be a green. So then you move into the next column and the same exercise or the same process. And you can do this in half an hour or less. So that will help you to give you how ready you are or where you need to fix or looking to mend certain things to make the company more efficient. Right. So if you are an executive board member or a founder and you want this international advisory board to help your organization test fundability, improve capital readiness, and build the proof around your next raise or market entry, let's have a 30-minute call so I can understand where you're standing today, what you want to achieve, and how an international advisory board can help you to move faster without hiring one permanent executive or paying a big consulting overhead. Excellent. Let's pause here for today and reconvene tomorrow, because tomorrow I'll move from predictability, this is a subject today, to the systems, pretty much the engine that moves or allows all this to happen, because even good revenue loses value if the company cannot control the structure, the reporting, and the risk underneath. Right. Have a great day, and I'll see you tomorrow. Thank you. Bye-bye.